Hey, welcome to the closing beat, everybody. Happy Thursday. I got it. Thursday. Yes. See? Aha. If I do nothing else right from here, then we're good to go. We're financial advisors here at Jazz Wealth. Hope you'll check us out because the shirt says so, and we're here to help and try to teach you stuff. So appreciate all of you that, you say, I want to get my dough straight. I'm going to go check these guys out, get started with them, see what happens there. I do appreciate that. Kind of a lot going on today. Not too bad. By the way, I saw Victor Pacheco, or P.
Oh, wait.
Yeah.
I think it's that one.
Huh?
I don't think it's that one.
Oh, okay. But he's gone.
It was a big move today. Yeah, big move today.
Oh, yeah. Okay. Well, I was kind of cheering for him,
That's where you went wrong.
Each week I pick a favorite, you know what I mean?
We have office bets.
Well, if you want to play Guess the Dow, jazzwealth.com/guess the Dow will give you $100 if you're the first to guess or the closest to guess without going over. And if you're a client, of course, we'll credit your account $100. Hint, Roth IRA is the way to go on that one there. So we got the Fed bank stress tests. They're out. Every single bank passed. They're free to distribute money to shareholders as they wish. You'll start seeing that probably now while you're watching this. Their banks are probably coming out and saying those things. Dividends, right? What dividends they're going to be paid there. They're essentially given the green light to do that. That's something that started over 10 years ago now, actually. Wow, that was quick. The S&P, if we take a look, continues its slow but steady summertime march. Right, trying to recover a little bit of this last pullback. So far, it's a little bit weaker than expected, or at least a little bit weaker than maybe some of you would hope. Year to date, the top 15 companies inside the S&P have contributed 34% in total returns, meaning their average gain is 34%. If you look inside the S&P, the median S&P stock has returned 1%, even after today. 1%. This goes to show you who's doing the heavy lifting out there. If we take a look over at the NASDAQ, we'll come back to the S&P in a second. Slight rebalance here today. You can see that happening. That's just money rebalancing from the NASDAQ to the Russell. We've actually talked about that in detail. Why is that the case that that's happening? If you want to learn there, there's one more day to go in the quarter, right? So we'll be through with the first half of the year there. Rebalancing is the lesson. We talked about this last week and the week before. Why was it going to be that there was money coming out of the NASDAQ, not to cause it to crash or anything, but money coming out of the NASDAQ? Where's it going? The Russell 2000. Why was that? It's kind of an interesting thing. Actually, if you look at the Russell 2000, more of that coming in today. Why else would you have higher volume, an extended move, a broad rally across almost the entire Russell 2000? Well, it certainly wasn't because of rates. We'll go over that in a second. But I can also confirm that rebalancing is happening from the winners kind of to the laggards there, because the biggest gainers were the weakest ones today. Money coming out of the stocks that have gained a lot, going into stocks to rebalance the whole portfolio there, or a fund's portfolios there. Dr. Horton, a great example here. Otherwise, strong stock there. Little selling pressure here today. It's up 35% year to date. Well, today it's pulled back a little. NVIDIA is another one. I think it's their best one. It's up 178% year to date. A little pullback here today. Meta, same thing. Just a little weakness. Notice we're not talking collapse and strength or falling apart of a stock there. Little weakness as it rebalances. Algen is another one. It's up 60% year to date, and that pulled back. Amazon pulling back today. It's up 52% year to date. United Airlines off to the races. Well, that one got sold off today. Big selling pressure there, down 4.5%. So that's another way to kind of tell what's going on there. Let's do a little bit extra here. Take a look at bonds. So whether you're looking at long-term bonds, short-term bonds, you see the price action today? I'll just zoom in so you can see. All right, fell apart. So I'll stick with the short-term bonds here for a second. Lower prices mean higher yields. And we talked yesterday about the Fed recession predictions there and how they come up with that. The 2-year yield is knocking on 5% for a 2-year treasury. 5.066 is a high. If we get over 5.066, that would be a 17-year high. What does that mean? It means those money market funds, you're going to be paying over 5%, likely going to be paying over 5% for a while. So good news for the savers, less good news for those that want the market to go higher. Remember, money can go elsewhere than the stock market now and yield a total real return that's positive, right? So if you bought the 10-year, the 2-year, whatever, you essentially have a positive real yield, meaning after inflation, you still made a few bucks. Not a lot, but you made a few bucks there, right? And they adjusted the inflation numbers again today. So inflation's actually a little bit higher there. GDP was a big focus this morning, right? So GDP revised higher up to 2%. Well, turns out we have a pretty strong economy there. They revised the number there. It was 1.4% previously. Why was that number revised higher? And you know what that means, by the way? So we got the GDP number before. This is old data. They come out today and they go, actually, with a better magnifying glass under the numbers, we find that that should have been 2%. So we're going to change it. Okay, well, what's your reasoning? We can't just make up numbers, can we? Some of you conspiracy theorists out there. Well, the reason was, and I kind of buy this, personal consumption on products and personal services consumption. That's a fancy way of saying you were buying stuff and you were buying experiences. You were spending money. Personal consumption was stronger than expected, came out 4.2% versus 3.8%. Services consumption was higher as well. And here's the kicker. You go, okay, well, so I went to the bar. What are we going to do, right? I went to the bar. I went to Disney. I went and I bought a new car. I bought some stuff. You know, what do you want? I got new furniture for the house. I'm not moving anyways because it's too expensive to move. That's essentially what you did, right? In really, really layman's terms. But then they said, well, prices went down too. Wow. So you paid less for stuff. Did you? Yeah, that one I have a little hard time with. Did you pay less for stuff? So now what they say is, headline inflation is the number that we usually talk about here. It's not what the Fed's interested in, but headline inflation is now 4.11%, just a little bit lower because you paid less for stuff. Core inflation, which is the Fed's metric that they like to follow because it's less volatile, a little bit more accurate. It takes out the energy sector, which is, it could be a little bit messy. 4.65%. Well, it's not 2%. Remember, the Fed wants 2%. So it's going to take a while to get there. Remember, the number's going to go up before it goes down. Fed knows that. That's why they're saying inflation's not going to hit 2% this year. It's not going to hit 2% next year. It's likely going to be the year after. But in the meantime, you're paying less and you're spending more. So therefore, our economy grew, right? You agree with that? Of course, if you ask Biden says there's no inflation in July. Did you guys see that? That was kind of funny. I'm just going to point that out. Is it okay if I point that out? Compliance checks? Okay. Biden says 0% inflation in July. And at first I was like, oh, well, wait a minute. That's a public number. We can see that. Maybe he meant to say something else. Doubles down, says 0%, 0%, 0%. Prices went down. And then it hit me. He said July. It's not even July yet. How's that possible? So depends on where you want to get your data, I guess, there. Okay, well, speaking of bonds, let's do this here. So we go over to, here's the S&P, and where do we stand with interest rates and the market? There's something really weird going on here, and this can't sustain itself. This might be why the market's like, it's just trying to go, but it can't quite get things going there. The market, I'll show you. The market has fully decoupled from interest rates. So bear with me for a second. In the blue, we have the earnings of the market, price relative to the earnings, right? And that's just the dark blue, easy to spot. And then in light blue, we took the 10-year yield, okay? But we flipped it upside down because the stock market is inversely correlated to yields. It is correlated to bond price, well, usually bond prices, but inversely correlated. So we just inverted the data, right? So you could see over time as yields go up, markets go up. I'm sorry, as yields go down, markets go up, right? That makes perfect sense. If things get cheaper to buy, you buy more stuff. Or I should say the cost to borrow to buy things gets cheaper, so you do that. So there's normally a correlation there, and to illustrate that, we just inverted the yield so you can see. On the right-hand side, the y-axis goes down technically as you go up. I'm sorry, it's just the way we do it. And so normally we're really correlated. In the past, when earnings took off, meaning we expected more growth, we expected companies to grow in the S&P, when earnings took off and became decoupled from yields going higher, that didn't last long, right? And it makes perfect sense if you're thinking just as an economist teacher in high school or something. You say, well, why would earnings go up if the cost to borrow is going up as well, right? So that makes perfect sense. You wouldn't expect Dr. Horton to sell more homes, more and more and more and more and more, if the cost to borrow, to buy that home, was more expensive. You'd probably have less people consuming, unless, in fact, we had a really, really strong economy. And that could be the case. It wasn't the case over here where we decoupled or had a little bit of a divergence there. This is the widest we've seen. I can't show you a wider one. I'd put it here if I could. So what do we have? We have the projected earnings, expected to go higher and higher and higher. But yet interest rates are going higher and higher, and in this case, lower, right? So they're falling, which means they're going up. We got a wide spread there. That can't last. So one of those has to give. Which one of those do you think is going to give first? Well, we don't have to think about it. We actually know the answer. Because the Fed says we're keeping rates here, maybe just a little bit higher, but then they're just going to stay right about there. And they wiggle around. Maybe we'll change our minds a little bit. Let's give them the benefit of the doubt. So we're up here, okay? And they go, this is going to happen the rest of the year and likely through the rest of next year. His words, not mine. So we know that this isn't going to change, right? Not much anyways. And by the way, this is the real yield, like I was trying to say a minute ago, where after forward inflation, that's expected to be the yield, right? So you make a few bucks. So we know that's not going to change, which leaves this. Again, another reason why you can't expect the stock market to have a 50% gain this year. It's not in the cards. It doesn't mean it can't be positive, but you just can't have a blow-off rally that can sustain itself. It can happen, and it's immediately just come back. So we'll see what happens there. I'm trying to point these things out while the market is sort of calm and there's not a whole lot to talk about. Because if I do it, just like I do with our clients here, if I teach you something that's maybe not such good news, if I do it when the market's kind of having a bad mood and it's just going crazy, you're not listening, you're emotional. You're like, oh my God, the market's falling. But if I do it when you're bored, you're like, oh, that's interesting. If the markets fall, I can understand that, right? I know ahead of time instead of saying, well, I guess I should have been doing my homework. So just something cool to look at. Only a couple stocks in the news here today. Ashland Chemicals is actually higher. They're doing $1 billion share buyback. That tends to move stocks higher, and obviously that was the case today. Speaking of buybacks, you got Occidental Petroleum says, we'll pay the 1%. We don't care. They're buying 2.1 million more shares. That stock was higher. That tends to happen as well. Constellation Brands, tomorrow you'll have earnings. They beat 77% of the time. I think you're going to find that they're going to beat. Why would I say that? I don't just make this stuff up. So I think some people are like, who is this guy? Like, what does he think he knows? This is my job. That's what I like doing. So I'm thinking you're going to expect to see Constellation Brands beat their Modelo and their premium juices, we'll call them, expected to beat as well. We already see that, right? I shared the data with you like 3 weeks ago after Memorial Day weekend. Sales off the charts. Modelo, #1 beer that's out there, right? And so from internal survey here, 57 distributors, okay? You could just ask them. You just ask 57 different distributors that account for over 200,000 retail locations. Hey, how you doing? You selling Bud Light? No? Okay. You selling Modelo? Oh, yeah, you are. Okay, cool. So you can get a heads up on that stuff. Of the 57 distributors that account for over 200,000 locations, they said the summer selling season has officially kicked off and is as strong, if not stronger, than last year, with Memorial Day being the push that got us going there. Memorial Day and forward, trends are broadly beating expectations. More than 60% of people said, distributors said that. So that gives you a heads up, right? They wouldn't just make that stuff up. That's what they're seeing. Well, you can translate that. So you bring that into something like Constellation Brands here. You got yourself a recipe for a beat. That doesn't mean the stock goes higher. In fact, 5 of the last earnings reports, the stock was actually lower, slightly lower there. So just pointing it out. We'll see what happens tomorrow, of course, and take it from there. Jazz After Dark, if you're interested and you're one of those that says, I'm going to retire before 65, we got some cool tips for you that we were talking about there. We'll keep that going. And our Wine and Wealth here tonight is going to be live again after some upgrading and stuff here in the systems. I'm actually going to do it from home. So if you're one of our clients, you want to come hang out with me tonight, I'll grab myself a drink. We'll come hang out. We are going to talk about the market. We'll give an update there. We're going to talk about student loans and some of the details behind that. We're going to talk about rebalancing, all kinds of cool stuff so that you can see with all of your money what's going on, instead of just saying like, the market was higher, it was lower. We'll focus on all that stuff as well. So I hope you'll join us for that. For the rest of you, thanks for keeping us in mind. Most importantly, thanks for watching us here. I know you have a lot of choices in your financial education, and we appreciate you giving us the choice or the chance. And that's all I have. Okay. Enjoy the rest of your day. We'll see you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.